I think whatever you're investing in, you've got to understand that liquidity is about to come out all over the system because they simply do not have the wealth that everyone thought they had. And whatever they've been spending, they were spending on leverage.
The housing market is drawing more and more attention as sales drop and inventory rises. Secretary Bessent says the Trump administration is considering declaring a national housing emergency, and that's not even the worst case scenario. Hello and welcome to Milk Road Macro, the podcast that knows that a real housing crisis is forgetting to pack until the night before you move. I'm your host, John Gillen, and today is Monday, September 15th. However, we will be releasing this episode on Tuesday, September 23rd, so just want to let everyone know that. And today we are joined by Melody Wright. Melody is a housing market analyst and commentator who was on the front lines of the great financial crisis. Since then, she's become one of the most sought-after analysts in housing and real estate and publishes a lot of great and wonderful insights on her Substack, M3 Melody. So make sure you follow her there. Check that out. Whether you rent or own, you are not going to want to miss today's conversation. It's going to be a lot of alpha breaking down what's going on in the housing market. So make sure you like and subscribe. Share this episode with somebody who's going to enjoy it. And as a reminder, we at Milk Road Macro publish a newsletter. Macro is very confusing. We have fixed that. The Milk Road Macro newsletter is your shortcut to understanding how the big picture works, how it moves markets. Comes straight to your inbox twice a week. Make sure you hit the link in the show notes below to subscribe to that so you don't miss out on any of the great content and alpha we're putting out there. And without further ado, welcome to Milk Road Macro. Melody Wright, how are you today?
I'm doing excellent. Thank you so much, John, for having me.
Okay, there we go. You're on now. I'm glad you're here. So look, I thought a great place to start this conversation would be just a kind of a quick overview for our audience as to where we are and what your macro framework is for housing. Our audience is very savvy investors. However, we haven't had a lot of people come from the housing market and real estate world. So I really wanted to bring you in to kind of give your perspective. So let's start with that high level perspective. What's your macro framework for the real estate market right now?
So I think for a lot of people that don't study this like I do, John, which is most everybody, is they hear a lot of headlines. But in reality, housing has been very bad for multiple years. 2023 and 2024 were some of the lowest sales we've seen since the last crisis. And we've increased population since about 20% since 2000. And so what's actually been happening is, although the media wants to focus on rates and why the Federal Reserve should lower rates, in reality, home prices just got too unaffordable. And there are a lot of reasons for that really start at, they actually start the late 80s, but our most recent crisis started at the end of the GFC when Wall Street came in at the behest of federal agencies to buy up all of the foreclosed properties because the banks were losing money hand over fist. We all remember kind of watching It's a Wonderful Life and thinking that the big bag banks can just come and take your house. In reality, it's a much more complicated process that is very expensive. And all of the banks were suffering immense losses as well as those government agencies. And so they kind of looked to the BlackRocks to come in and be that distressed asset manager, and other, private equity came in. And so my point in saying this is that the housing market became about investors, and really that's what we have to understand about this housing market right now. So who was transacting in 2023, 2024? It was investors. It was people that could come in and pay all cash, and they were kind of moving out that first-time home buyer. So just a little fact, it was the lowest amount of first-time home buyers on record since they started tracking in the 80s last year. And so 23 and 24 were just kind of this mirror image of one another because rates were fairly stubborn. We had some pockets. But 2025 is and we did have some what I would call motivated selling, but 2025 has really been about this turn from motivation to distress as inventory has just continued to increase, and it's going to. So I guess what I want to say is it's been pretty frozen, and it's been about the investors and those that, so you had kind of, just like we have a K, it's the investors, it's those that can afford it that are transacting, as well as those that are getting these FHA programs, which are really the government subprime of this cycle. And they're finding ways to be able to pay these high prices through down payment assistance programs. And so that's kind of where we are right now. But those programs are running out. The investors have pulled back because they can no longer cash flow due to increased property taxes and insurance. And so we're watching as we speak home prices start to make that turn and start to come down, led by states such as Texas, Florida, and California.
Gotcha. Okay, so there's a lot to unpack there. If our
Sorry.
audience is listening, we're not gonna. Yeah, no, it's a great framework. This is why I wanted to start high level, so we have time to unpack this stuff. So we'll kind of take this piece by piece. I thought a good place to start kind of digesting this was, talking about the housing market bubble, if you want to use that word. Everyone does, but you've highlighted something recently that I thought really kind of gets to kind of the issue in the market that we're seeing. Home sales are the worst we've seen in over 30 years, as you said. And we've also had a population increase since that time of 20%. So it would make sense that there would be, a higher demand for these things, right? So what is the reason for this frozen lake? Is it people not wanting to refinance, people not being able to afford homes? Like, what in your view is driving this huge decline in home sales that we've seen specifically?
The largest driver is unaffordability. This is the most, some would argue, that it's the most unaffordable on record, and it really is. You can kind of make minor arguments against that, but it's really bad. And so what's driving that is, we just have not seen wages keep up with inflation. And right now, your median home price for existing homes, think of this, you've got to think of the housing market as the new homes and the used homes. And right now, the used homes, that median price is around $420,000. Our household median income, not individual, household median income right now is around 80,000. If you're making $80,000 a year, you can comfortably afford a house for about 275,000 or 300,000. And so what happened is all the investors piled in. They were buying for short-term rental, long-term rental, and some just, were buying to fix and flip to sell them. This was a big part of the game, and that kept those median prices up. Meanwhile, though, on the new home side, you've seen those prices just really tumble is the best way to put it. They've restated prices, so it looks a little better than it did. But what you're seeing so this is just quickly a stat. Since 2012, new homes have averaged about $50,000 more than existing homes. They are now less. That shows you just how out of whack the market is. But unaffordability is the biggest driver.
So just I want to move on to some other questions here, but just so our audience understands, why is that so out of whack that flip has happened? Explain that just so everybody understands why.
Well, I mean, with most things, if you're going to buy a new coat versus a used coat, which one is going to be more expensive?
Right.
You're theoretically, these homes are being built to new codes, all kinds of different things that you don't have on those it's new, a new roof, for instance. An existing home, you might have to replace that roof in 5 years. So simply put, it's because it's new.
Right. So it's new and the market should be prioritizing that, but that is flipped. So now existing homes are selling for more. So what we're describing here is this bubble, right? Which is that there is a lot of inventory on the market that's not being bought up because people can't afford it and sales have dropped. So now what a lot of people are kind of anticipating is that the prices of homes will eventually collapse because there's no demand, the prices will come down. And people have been looking at ways to kind of see where that's coming from. I wanted to ask about something you've been tracking 85 oddly specific towns in the country to get sort of a leading indicator on when this correction might happen. I would
Sure.
love for you to explain to our audience how you identified those. What's your thought process there? Why are these vacation towns so important as a leading indicator in the market here?
Sure. So I did kind of a combination when I chose those towns, and I crowdsourced some of them. Like, of course, I did your most important metropolitan statistical areas or MSAs, all the big ones. But I kind of crowdsourced as I was hearing from investors all over the country for these markets that got heavily into short term rentals, like, for instance, Galveston, Texas, or Cape May, New Jersey, where people were buying up these homes to do short-term rental because during COVID, families went nuts. You would have families of like 20 going to these places and want the perfect location. So then you had people they weren't satisfied with just kind of buying up those existing homes. They started building for spec, building for short-term rentals here. And so I knew that because for people got into these markets so heavily with that speculation, they would be kind of bellwethers. They would tell me first when things were starting to turn, and sure enough, they did. So that Austin, of course, would have been on my list one way or the other. But in Austin, you have 15,000 Airbnb slash Vacasas or short term rentals, and you don't need 15,000. You have a whole lot of other things in Austin too. But Austin was one of our first indications of what was going on, and Nashville, Tennessee which is if you go downtown, it is nothing but Airbnbs.
So great. That makes a lot of sense. I think that people need to kind of come up with some way of getting their hands around the idea of the market as a whole. And I thought that was a really interesting approach of looking at those specific markets, those 85 towns. So I want to kind of like step back a little bit here. There's a lot of people saying we have like an affordability crisis, and so we need to build a lot more affordable housing. At the same time, we're seeing tons of homes go unsold. How can there be both a shortage and an excess of supply at the same time, or is somebody misreading the market here?
They're totally misreading it. In fact, I don't think they're misreading it. I think that they know that the inventory shortage narrative has been pushed out there. And so they have to speak to it because it has been the drum that this industry has marched to, that there is a shortage. Now, I will absolutely tell you there are no affordable homes out there. That is a fact. But what we have is a misallocation of inventory. We have 15 million vacant homes in this property. That's not even including those seasonal homes. The boomers have, first, second, third homes, and then as well as we the institutional investors. And so essentially, you've got the situation where people misread the market, as you say, and thought because there was so much activity, all these bidding wars, those weren't you and me. Those were institutional investors and even kind of what I would call larger mom and pops. That is what so many folks and what they did, John, quickly is they looked back and they said, "Oh, well, we did all this building, during the GFC, but we haven't built it all." Well, we pulled forward demand back then. And then during COVID proper, we also pulled forward demand. So they do a demographic study every year on household formation. And they said what we're facing in the future because of that pull forward demand is a lot less demand. And then you have to consider that the boomers are aging out and we'll lose 15.6 million of them by 2035. And they own the majority of the homes.
Yeah, so this is, I think, something I was going to get into, but it's kind of a big topic, which is like how do demographic shifts impact this, right? Like you said, like new family household formation is declining. People waiting later to get married and start families. Boomers are starting to bring their inventory onto the market. How much of a driving factor is that in all of this? Is that like, yeah, how are you thinking about these demographic shifts in terms of like the changing needs of housing for the country, I guess? Like how much of an impact is that having?
Well, it's massive, right? And so if you think about it, I'm helping several people right now who have inherited properties that they simply cannot afford, or there's some sort of problem because we've seen, because of those accelerating home prices, we've seen property tax increase. We've seen insurance just go bananas. We've seen replacement costs. And so these kids, they don't have those incomes to support those homes. And so often what you're finding is that they're selling those homes. And so right now, the average household size, what do you think the average household size in the United States is?
Oh man, you put me on the spot.
I know, I'm
Um,
sorry.
Three.
Right? And I remember back when we used to talk about it being like 4.2, like I was younger. But in reality, it's around 2.5. Okay. And so what we've done, and that has just been going, that average
It's
household
going
size
down,
has just
right?
been going down. Well, for the first time last year, it didn't because homes are consolidating because they no longer can afford. But I have a friend, Kenny Cap PhD, who does demographic work, who says, "What do we want to get down to one house per person?" I mean, is that what the kind of country we want to live? Because it leads to productivity, right? Like, we don't have enough workers. We're not birthing babies at replacement rate right now. And so we're going to lose productivity. We're going to lose the ability to afford the homes that we even have, even though they're already unaffordable. And so I think the shift is massive. And there are so many people that just aren't understanding what's coming next.
And what's coming next is what I want to talk about. I want to ask you a few questions about the Federal Housing Administration and workouts. Before we get to that, though, I think this what's coming next thing is kind of where I want to button this up. A lot of analysts are saying that the market's bottomed and we've come through this 2 year period of frozen lake of low sales and things are going to start picking up. And yet, what you're describing is this kind of like large scale collapse in housing prices, and that would have huge impact as well. Describe for me what's coming next. Do you think that they're like these analysts who are saying we've bottomed are missing something? What are they missing? And then what would those consequences be if all this inventory in the market leads to a collapse in housing prices?
Yeah. So, what are they missing? I feel like they make spurious arguments based on things like saying, "Oh, well, dual incomes, people will be able to afford it." No, we've had dual income since the '70s, so that's not going to be new. And so, it simply comes down to the jobs, John, the jobs that pay that would make it possible to afford homes like this. And what have we been hearing a lot about? We've been hearing a lot about AI, and we've been hearing a lot about job losses. And, Challenger came out last week talking about layoffs being the worst they've seen in August since 2020. And before that, August of 2008. And so, how exactly are people going to afford all of this inventory that was newly built out there? The builders have over 9 months of inventory right now, the highest since 2007. And sales are tepid, and then you have inventory on the existing side. So how I just keep asking, how are they going to be able to afford it? And then you tack onto that, you're going to see increases in inventory as more of that speculation rinses out of the system, and then you're going to have increases in inventory for the boomers who, again, like I said, own the most of real estate coming onto market as they age out or are downsized to one of their 2 to 3 homes.
Yeah. So I think that that's helpful insight there. There's a lot of people who have a lot of perspectives on this market. Again, one of the things I think is difficult about housing is that it is such a large market. It's disparate, it's illiquid, it's slow moving. And so analysts oftentimes disagree. But it sounds like what you're describing is another symptom of this K-shaped economy that we've seen, where we've seen huge outperformance by the hyperscalers and companies that are driven productivity increases driven by AI. But an economy is not made up of productivity or AI; it's made up of people. And if people don't have the jobs that they need to be able to afford et cetera, the housing market is impacted by that, and this is one of those symptoms. I want to turn now to something that the Federal Housing Administration has been doing to sort of help in this environment. But I thought it would be a good place for you to just define for our audience at the beginning, what is a workout, and how does that work, and what do our audience need to know about the impacts of the workouts that the Federal Housing Administration has been doing?
Well, so workouts became a real big thing after the last crisis. And so you had a situation for where mortgage got into trouble for not properly handling loans. And they came under what was called a Federal Reserve consent order. And they were told they have to offer loan modifications. Now, what's a loan modification? Of course, you sign a contract when you take out that mortgage. But basically, what it was is that the banks, non-banks, had to look at your loan, look at your new circumstances, and try to come up with a workout for you where they could reduce your payment to something that you could afford while making their investors whole. Because what a lot of people don't understand about this market is that it's mainly government now. There's hardly any private players, and they bundle up those loans and sell them off. So they have to make the investors whole. So a workout is simply, how can I help you to get caught back up, to make those payments, or maybe modify that loan just a little bit so that you can afford it again. Now, the biggest workout we know about, most people know about, and I'm going to talk about some more, was the forbearance during COVID. But that those foreborn parent payments had to be handled some way, and that's where we'll move to talk about these specific programs. But I'll stop there to see if you have questions.
Oh, that's very helpful. So, a workout is another way of saying that the Federal Housing Administration has been helping people who aren't able to meet their monthly payments to kind of stay in their loan contract, stay in their house, and kind of work out another solution. Let me just kind of ask a leading question here. Does this have any impact on the official delinquency rates and like what that data is showing? And might this be one of the things that analysts who say we've bottomed are missing in the data here?
Yeah, 100%. And I'll tell you, I'm the only analyst out there that's ever worked in mortgage servicing. And they don't understand this. They understand the front end of the business. And so what happened last year, in election year, you could see starting in June of 2023, we started seeing this FHA component. Now, let me be clear that the other government agencies also do workouts, but we'll talk about this government subprime first, which is about 13 to 14% of the market. They started becoming very delinquent because you can have a a credit score as low as 580 with compensating factors, 3.5% down. And by the way, there's down payment assistance programs you can tap into. And we also know credit scores were inflated. And so we have this huge subprime category. They started getting into trouble even after all the what I would call really aggressive workouts, because back in the day, John, no matter what, we had to re-underwrite that borrower and say, can you afford this or can you not afford it? Show me your financials. That all changed during COVID. They would send you a modification in the mail before you even called, which was crazy. Whether you could afford it or not, it didn't matter. That was what the administration wanted to do. Well, that itself, 40-year modifications weren't enough. Existing programs weren't enough. And so then they came out with this thing in 24 because they could see the writing on the wall. If they didn't come out with something new, we would have material delinquency before the election. And so they came out with this crazy program that basically said you could just keep going back to the till. If you got 3 months behind, you could go back again. 3 months behind, go back again. In fact, many people got very wise to this, especially investors, and they never even made a payment. And they would just go in back, and you could do this for up to 30% of your unpaid principal balance. That is a massive amount of money. And so what's been happening is over the past year, people just keep, every time they get in default, they go and they push it back to the back of the loan, push it back to the back of the loan in a non-interest bearing lien to be paid when you pay off the loan or sell it, because everybody believed in this economy that people could just turn around and sell. And so why would we, but in reality they couldn't. And that's why they came up with this FHA program.
I feel like in a few years, I'm going to hear Margot Robbie explaining this to me from a bathtub.
You might.
But yeah, exactly. So just for some scale on this for our audience, the Federal Housing Administration has waived or reduced, I think it's now over 1.2 million different mortgages. So this is a pretty large program, pretty large impacts. It was done in an election year. I can't imagine why that would be. But I wanted to get your thoughts on so I wanted to get your thoughts on, so the Philly Fed published a report on some of these things, and we'll talk about what happens when this program ends in a minute. But for now, the Philly Fed published a report on these, claiming that they believe that there's a large amount of fraud going on with this. Are you familiar with this report? What stood out from you from this? Tell me about what they said in this report.
Well, basically, they said, firstly, listen, investment in mortgage has not stopped since 2008. And they basically said that anytime you have investors, that you can pretty much bank on 30% of them being fraudulent transactions. Now, what's a fraudulent transaction with respect to mortgage? Well, a lot of investors will claim that they're getting the loan out for a primary residence, that they're going to occupy that residence. But in reality, they never have any intent. They're getting those favorable loan terms and lying and saying they're going to occupy it when really they're going to rent it out or do short-term rental. So this mortgage fraud has been in the headlines over the last couple of weeks, but this is a rampant issue. And, everybody does it on both sides of the house. I'll tell you that much.
Yeah, it's. I think this is one of the things that both parties can agree on, is that, well, anyway, they like things to come out in their favor, especially when they're up for re-election. Okay, so I think what I want to ask about now is something you've alluded to already, but this program is coming to an end soon. Tell me what that looks like. What's the timeline? What do you expect the impact to be? And what should investors be watching for as a signal that this is having an impact on the market?
Well, firstly, let me just say that mortgage is very slow, and all of these rules that came out after, in Dodd-Frank and the national servicing standards means it's very slow. But basically, what they're going to do after we lobbied hard is there will still be workouts, but there's going to be guardrails on them. So one, which is just crazy, you did not have to make a trial payment on this workout before. And typically this was something we all learned during the past crisis. You want them to have skin in the game, or they're not going to be successful in the workout. So that's one thing. Now you have to make a trial payment. The other thing is now you can only get one of these every 24 months. This is so huge. And then the last thing that is going to be very impactful is if you have a delinquent student loan, you will not be eligible for any FHA workout. Now, this is, we've learned, probably HUD themselves said they have about 40% of FHA borrowers are in a student loan or have a student loan. And we know about 10% of them are delinquent right now. So what's going to happen? So those guardrails go in place on October 1. they will still be able to get one more shot, if they haven't reached that 30% maximum. Okay, they fail out of that, but the servicers will have to wait 3 months before any of that. So a lot of complicated things, but we will probably start to see material foreclosures in Q2 of 2026. But already what you're seeing is when people get that foreclosure notice, they turn around and they start cutting prices, like if it's for sale. And so you're going to have kind of two populations: the investors who either just walk away. We saw so much of that, or they cut prices. A lot of the families aren't going to have a lot of anywhere to go. And so what most learned last time is that even if they are in foreclosure, it could take a really long time. And so these two things are going to pull on each other. But I believe that we'll be well aware of the foreclosure issue starting in Q1, but in Q2, it's really going to start accelerating.
Gotcha. Okay, so you're forecasting foreclosure increases in Q2 of 2026, which should exacerbate a situation where we already have a large amount of inventory on the market and should drive housing prices further down. I want to pivot towards possible policy solutions or what can be done about some of these things. The initial idea with these waivers and reduction of payments and these workouts was that eventually rates would go lower and mortgage holders would be able to refinance their way out of the problem, meaning they would be able to get to a place where their monthly payments were lower and affordable, and they could stay in their loan and kind of make it through that period. A lot of people are hoping that the Federal Reserve rate cuts, which are coming as we speak, hopefully this week, would help with this situation. Do you agree that that's going to help? Is it going to be ineffective, too little, too late, or would they need to cut like a huge amount for it to actually make an impact on the market? Like, how much do you think this is going to move the needle, or does it really not matter that much?
Yeah, so let me just offer one clarifying point to my last answer. So we're going to see foreclosures increase from here year over year, but we will really start to see them accelerate in Q2 26. But to your point about the Fed, so people really don't understand mortgage rates, and mortgage rates are, move independent of what the Fed really does. We saw this in spades last September when they did that jumbo size cut, and then mortgage rates proceeded to go up, because really mortgage rates focus on that 10-year treasury rate and what's happening in the bond market. And so Powell can cut all he wants to this week. The bond market may not respond. It's already responded somewhat, which is very similar to what happened last year. If you read mainstream media, they'll tell you that the 10-year treasury did a front run of those rate cuts. But then mainstream media didn't really have an explanation for what happened next. And so, we're seeing kind of that similar pattern. But what's going to happen after those rate cuts? Well, I'll tell you that it's probably going to really depend on the market order or disorder at that moment, because I think what we're starting to see are collateral shortages where people may be exiting out of their long-term positions because they need short-term collateral to pledge. If you watch The Big Short, you understand this is just a liquidity game, right? This is just moving liquidity around the system, and maybe some of it's real and maybe some of it's not. But when you get into trouble, you have to move quickly, and those short-term treasuries are what you really need to be transacting with. And so I'm not exactly sure what's going to happen, John. I'm totally fascinated to see if we get similar behavior. But when I think we're about to get into a point where everybody is going, a lot of people think that central banks work together, right? Well, I think we're about to get to a point where people are defending their currency, defending their situation, where they're not going to be able to act like that flight to safety trade that everybody was talking about. Now, we might get something like that, but to your question, really, we would need mortgage rates far below 6%, below 4% to be able to do, get a refi boom, even similar to a refi boom we saw in 2010, and it didn't slow things down. Or the Fed would buy mortgage-backed securities. Now, I think I think there would be an uproar if they tried to do that again, and I think that's why we're hearing about. You can talk to people on the street. When I travel all over the country and just interview people, they say, "Well, the Fed bought the MBS." I'm like, "Whoa," But so what are they doing now about this national emergency? Oh, Fannie and Freddie will be able to, buy MBS. They'll suicide themselves if that's the case, and so there could be a vested interest in that happening as well, because I think the banks want want to get back into mortgage. They got pushed out with Basel III, really restrictive requirements about holding mortgages last time. And so it's a short answer, John. It is so complicated, and we are in some really interesting times. So I don't care what Powell does. I care what the bond market does. And so I'm watching the 10-year like a hawk.
So I think there's a lot of wisdom in what you just shared. I want to try to synthesize a couple pieces of that for the audience. In a recent interview I did with economics professor Robin Hanson, he talked about how markets are not only a way to speculate or distribute risk or secure returns, they're also an information generating machine. And so, for our audience, what Melody's describing here is that Powell is going to make a policy change. He's going to hope that has a certain impact, but the real truth of what that impact is going to be what the market says, and that's in the prices of the bonds, the prices of the mortgage rates. And so, as much as people might want things to be a certain outcome, we really at this point have to pay attention to what does happen, and then be willing to adjust our position, our framework, our outlook based on that. So this is one of these times where I think we've got multiple dissenting opinions on the Fed board. We've got multiple dissenting opinions across the landscape of analysts. And just like you said, it's such a big multivariate system that's all interconnected. Now is a really important time, I think, for investors to just be paying attention and, without being dogmatic about what must happen, just really be tuned in closely to what does happen, so you can adjust accordingly if you need to. I want to ask about this Trump administration national housing emergency declaration that Secretary Bessent has floated. First of all, how serious do you think he is about that? What would the reasons for that be? Would that be beneficial? Do you think there's anything they could do under those circumstances? Like, walk me through what your thoughts are on that, and the realistic possibility of that happening, and what does that mean? What do we do then? What happens next?
Yeah, well, I've been once I went on the road in January of 23 and realized that I was being lied to in mainstream media about what was really happening out there, I became a really avid watcher of narratives, and watching the way certain articles would get published at certain times when policy people wanted the narrative to change slightly. And so I think there's a lot of noise out there, John, right now, a lot of noise. And it's hard to hear the signal. But so far, what this administration has done is not do. They've put the guardrails on the FHA program. They've cut the budget in some ways for some of these housing programs, not in all. They funded too much of it in the BBB. But a recent op-ed by Bessent, as well as a story in the Wall Street Journal about that you just quoted, actually, about how many people have received these workouts. I think if I look at these two stories together, it tells me that national emergency headline that came out, I'm not going to be too concerned with it right now. And then I looked at what is the detail. Getting rid of regulations to build more, like you and I have talked about, that's not going to make a difference because we already have way too much inventory. Do I think they'll bail out the builders like they did last time? Sure. Do I think that the builders will be like, hey, government, we'll get in some program with you or some NGO or nonprofit and, to give reduced cost housing to people, but building more is not going to help anything. That whole Fannie Freddie thing, that I'm so curious about this one, and I don't see any serious moves to make it so. And if it does happen, it's going to probably work out differently than they expected. Or maybe as they expected. But my point being that this national, I think a lot of that is just rhetoric. They've got to perform some sort of care and concern because this is impacting a whole bunch of people. But what they're proposing right now is not going to make a difference.
That's kind of grim, but I think you're right. No, it's true. But see, I think this is an important thing to understand, right? Is that there's a lot of things that are talked about in public, but some of it's just public relations, and it sounds good, but it may not actually move the needle. There's a lot of that going on in New York City right now about like, oh, we're going to freeze rent, and that doesn't really fix it. Right, exactly. But so this Fannie and Freddie thing you've alluded to a couple of times, just so our audience knows what's being proposed there, tell us what that proposal entails, how they're thinking about changing what they can do, and like why you think that's not going to work, just so people understand.
Well, it all comes, back to the GSCs or government-sponsored enterprises. Fannie and Freddie were put under conservatorship because of all of the losses that they faced, and so there's a whole bunch of investors that got burned back then, and big angry lobby group that wants still to see them to go private again, and but the problem is that the reason why people see that mortgage-backed security as pristine collateral is because it has the implicit, guarantee
Guarantee.
of the government, and as well as they pay the claims for the servicers. That's very complicated. We won't go into it, but there's a lot of reasons that you don't understand on the face of it. And so this system is so complicated, and they're talking about privatizing it and doing that a couple of different ways they could. But in reality, this would, in my opinion, would work out very differently than they anticipate. And it's one of those things, Ackman, I think they're trying to, he invested heavily in this. And so I think they're trying to give lip service to him and to others. But in reality, if this goes forward, it's going to be for reasons that nobody is really understanding. And that's that the banks want the GSEs out of lending.
Yeah, so for the audience, she's referencing Bill Ackman. He's been very vocal about some of these things on Twitter. If you're interested, go check that out. So I don't want to get too deep in the weeds on some of these things, but I did want to kind of address that and get your thoughts on it. Very helpful. I think the thing I would like to hear some more of your thoughts on is something we've alluded to several times in this conversation, which is that housing in this country is both a solution for shelter and a vehicle for investment. And I'm curious on what you see there as like what's possible in terms of disentangling those two things. Do we need changes there? Should we put restrictions on foreign purchasers in our environment or investment operations in our environment? Like, what do you think is like a practical solution for that problem? Because I think a lot of people now are very aware that, hey, banks and investors are really who's in this market and controlling it, and it's making it really difficult for human beings to find shelter. So, like, what are your thoughts on that issue? Just broadly, I guess.
I think if the government would just stay out of it, I mean, I think that would rinse the market completely out. I mean, right now, the institutional investors are selling to one another and hanging on for dear life, using those sales to do refinances at prices they'd never get in the open market. And so, in reality, a lot of people say, "Oh, investors can't be in this anymore." Da 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 da. Keep the government out. Like, use the remedies they have, prosecute this owner occupancy fraud, or just research it better, enforce it on the upfront. I'm a big fan of free markets, and so I think if people just step back and let this all play out, we would find, and it would become about shelter again, John. And I think one of the most eye-opening moments I've had recently is when I was just diving into owner's equivalent rent and diving into the CPI, and the actual definition. They consider housing as an investment in CPI. And so it's not, I just don't think we can blame all the investors and things like this is it's for the well effect. This is how they want everyone to see it, so that you'll continue to go out there and consume, because 70% of GDP is consumption. And so it's incumbent upon them to actually teach us to see housing as an investment, when in reality it's just shelter. And so if they would back out, and of course, if we need to get some quick relief here, yes, let's just say no foreign owners. I mean, because this market has been used for money laundering and all kinds of, I mean, you can go to the ghost condos down in Miami. And there is so much vacant housing all over this country. And so maybe you could do a temporary restriction on that, or something like that.
Yeah. Well, I live in New York City, and the couple of blocks south of Central Park we call Billionaires Row, and there's very few people who actually live there. There's just a bunch
That's
of
right.
residences. They're investments for people
That's
that we
right.
love. We're very grateful for them, and we thank them for their business. I used to work at BlackRock, so I have a lot of thoughts on this whole thing that I'm not going to say right now. But I would like to just kind of go back to something we've talked about a couple of times, which is like, where you really made your mark was covering the great financial crisis. I'm really curious to just get some thoughts from you around that, and like what key lessons from that do you think haven't been learned? Like, maybe is like a good way to ask the question. Like, what are some things that you think we should have taken away from that we didn't, mistakes that you think we're repeating, or just anything from that experience that feels similar or reminiscent to where we are today?
Well, I feel like we made a huge mistake back then when we broke contract law, and I think that did all kinds of things to this country. And John, was kind of curious if maybe we had crossed paths before. I worked very closely with BlackRock during that time. We didn't learn any lessons, and I think instead what happened, it's kind of like when you get sick and you take some antibiotics, but you don't finish the course and the sickness comes back with a vengeance. I think that is or the infection. This is exactly where we are right now. And so, unfortunately, as much as the industry did a lot of credit quality gospel singing, certain actors might have learned a lesson, like the banks. They stayed out of it. Instead, it's big non-banks like Rocket and United Wholesale that are doing the mortgage lending out there. No one else learned any lessons. And the government basically came into the market and took the place of private actors last time and did all that risky lending. And so I just feel like we're actually just potentially could see that crisis finally play all the way out, John.
Well, that'll be fun. I look forward to living through that as a millennial. Look, I don't know exactly what's going to happen with all of these things, but I do think that what I want the audience to take away from this is that what happens on a lot of these systems is we kick the can down the road, we paper over problems, we kind of like keep the whole merry-go-round going, but we don't really solve a lot of things. And so as a result, just like you said, that same crisis, it could still be ahead of us in many ways. Okay, so let's bring this back to some practical things for the audience to take away. What do investors need to know? Look, I'm not a home buyer. I'm not selling a home, right? Like, do I need to care about the housing market? Why does this matter for me? What does this have to do with the price of rice, right? Like, what do I, as just like a regular investor in the market, need to know about the housing market? How does this impact me? How do I need to prepare for this crash that might be coming? Like, what should I know as an investor in Q4 of 2025?
Very simply, that people spent based on a false idea of their wealth. And so whatever you're investing in, you have to understand that they are not as wealthy as they think they are. And that's going to have all kinds of implications, from not being able to pay student loans, credit cards, autos, mortgage. And then that's going to have your secondary impacts. I mean, we can already see Sherwin-Williams, all these, all of the goods, household goods suffering. And so as an investor, I think firstly, this idea of a strong consumer was held up on a false idea of that equity in their home. And we didn't talk about but there's a lot of reasons why the Fed's household and debt schedules don't understand how much leverage is out there. And so I think whatever you're investing in, you've got to understand that liquidity is about to come out all over the system, because they simply do not have the wealth that everyone thought they had. And whatever they've been spending, they were spending on leverage. And so I hopefully that's helpful. But I mean, this is going to be impactful no matter what you're investing in.
I think that's a really great overarching insight. I think that that's something everybody experiences too. We can feel that we are in many ways at overvaluation levels in many assets, in many risk assets, in many markets. And people can also feel that the economy is not as strong as they've been telling us it is. And so, I think that at some point there will be a resolution to this. I don't want to get overly bearish though, because I think that the risk. So, and just like a thought on this is I've been thinking about a lot, right? Is like, even if you're in a bubble and it's a bubble, there's a risk to not participating in the bubble too. So you don't want to be blind that, hey, liquidity is going to start coming out. This could bring valuations back down. You want to be paid attention to that, but you also don't want to miss that. Like, one of the solutions to this is they're going to continue to print money, continue to debase the currency, and that could continue to push valuations up. So I think it's a great time, like I said earlier, to just be paying attention, staying engaged. Mm-hmm. Melody, I think you are one of the most helpful analysts I've ever spoken to on the housing market. You make it something I can understand. You can translate it into English, and I can see what's going on. Where can we send people to find more of you and your work online?
Sure. So you can find me on X Twitter at M3_Melody, at M3 Melody Substack. And guys, I put a lot of data in on the free part of my Substack, because this is important to me, because I'm concerned about the millennials and Gen Z, and also on M3 Melody YouTube.
Fantastic. Thank you so much for being on Milk Road Macro, Melody. I learned a lot. I'm sure our audience did too. I hope we can have you back again soon. Thanks so much for being here.
Thank you so much for having me. It's been my pleasure.
And thank you all for joining us. I hope that you will all stay safe, stay bullish, stay smart, stay educated, and join us on the next episode of Milk Road Macro. Thanks for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.